Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. And now, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. We'll be talking about screening call spreads by historical IV benchmarks. How are you doing this morning, D?
Good. How are you all?
Great. Let me bring up your screen.
Yep.
There you go. And there's the landing page.
Yep. Good morning, everyone. And first, let's navigate to our call spread screener, and then we'll discuss how to look at a call spread and evaluate it based on implied volatility levels. So up top, we have the main menu. If you hover over the screeners to the right-hand side, we have bull call spread. So I'm going to click on that. And this will take us to our screener. You can see up top here, we have our filters that we could tab through. And then below, we have our data elements and analytics for different combinations of call spreads. We also have different tabs here. So in this video, what we want to do is kind of discuss if we have these call spreads, right? So reading it from left to right, we see in NVIDIA, we have stock price, market cap. These are some analytics here for valuation of the call spread. And here we identify the call spreads that we are analyzing. So you could see here, November 21st expiration. These are looking at bullish call spreads. So buying the 255 strike, selling the 260 strike. But you could see that in November expiration, we could have different combinations of strikes, such as 252.5, 257.5. 250, 255, all these different combinations. And we could do them in different expirations as well. And since we could do them in different expirations, we could do, and it involves two different strikes, right? We have buying one strike, selling a different strike. How do we compare the market price of this spread, right, 49 cents, to get an idea if we're on the high end or low end of the historical range? So, for example, a lot of people reference IV, and we get right implied volatility. And when we look at an IV benchmark, let's say IV 30, right, the implied volatility benchmark with the implied volatility for a 30-day constant maturity at the money option. Well, that only allows us to compare that to a 30-day at the money option, right? That doesn't tell us what if this call spread is priced on the high end or low end, especially when we're looking at two different strikes that you're buying one and selling the other. So now you have a skew situation going here where even if the implied volatility is high, well, that doesn't mean that the call spread is high on a relative basis because you have two different strikes there, right? And one strike they could both be elevated, but the strike that you're selling could be much more elevated than the one you're buying. And if it's implied volatility is low, that doesn't mean it's necessarily cheap either, because the option that you're buying, while low, the relative value of the option that you're selling could be much lower, where you're still on a relative basis when you're doing a combination. You need to factor in both those options, right? You need to factor in both those options and the relationship between those options. So let's just kind of go then to a different valuation. So this valuation looks at historical stock price moves. So first, what I want to do is actually I'm going to click on this volume analysis tab, right? So while I'm on this volume analysis tab, we're gonna look for spreads, bullish call spreads that showed a lot of trading on a day. So these are actual trades. So if you sort this by volume, it's going to show you lows to highs. I'm going to sort it again, and I'm going to see highs to lows. So here we see in symbol upward, UPWK, I think that's upward, right? So UPWK, right, yesterday traded 9,444 contracts in the November 21st, buying the 17 and a half strike and the 20 strike. So this call spread you could see traded for a VWAP price of 55 cents, closer to the offer. But that's the price, right? So now we know the price of that option kind of traded near the offer, traded over 400 two times. But on a relative basis, was that on the higher end or lower end based on the implied volatilities of both the lower strike and the higher strike, right? Buying one, selling the other. So then we could go here, historical IV view. That's what we want to see. We want to see the implied volatilities. I'm going to click on that. So here, actually, we don't have enough data. Let's go to the group on. So the Upwork didn't have enough data because this was an earnings period. So we didn't have, so when we have earnings, we have to go back in history and look for enough data points in a similar situation, right? Earnings, because we can't take non-earnings periods and take that implied volatility and use it as a basis to compare it to a market where we do have an earnings. So the system is looking for similar situations, right? In other words, if you know that earnings are coming up in a day, we need to go back in history and look at implied volatilities of similar options with a day to go to earnings. And if we don't have enough observations, it kind of just doesn't create any analysis because, using just one or two observations is just not enough. But let's take a look at Groupon, right? So Groupon, this traded 7,596 contracts in this spread, the November 21st, 25, 28 call spread. And now let's take a look at this IV. So this is saying that the current market price is 85 cents if you went to buy it on the market, right? So because it's a bullish call spread, we're analyzing the ask price. But based on the implied volatilities, historical implied volatilities in similar situations, the average value is 60 cents, which means now that this is on a higher end of the historical range. And actually, this one has an earnings coming up November 6th. And what this is saying is, let's just open it up and see what it looks like. So this is the data. So you could see here that it's going back in history and looking at similar situations to see, well, where were the implied volatilities of these options? So it's given an implied volatility, you could see, of one versus the other. And if we applied that implied volatility to the options today, this is what it would be worth: 57 cents, 54 cents, 65 cents, 62 cents, 60. So you could see it's going back in history all the way to 2021. And it's saying that, okay, we found similar situations. These were the implied volatilities. If we took a snapshot of the options chain, so we could see exactly where both implied volatilities were. If we applied those, these would be the theoretical values. So how does that, right, compare to today's value? Well, on the offer, ask price, it's 85 cents, it's below. And based on our values, we didn't have any that were as high as 85 cents. So this would be now on the higher end of that historical range. Here's our historical range, as low as 47 cents, as high as 75 cents. Okay. So this is saying that right now that ask price is on the higher end of the historical range. We have 17 observations here. So let's just take a look at one more time, the market. So here's the market. The other thing is that the bid and ask is 35 cents, 85 cents. So that's an important thing to understand also, that this is a wide market. We're analyzing the ask price, which is where, so right now that's the displayed price that we could trade on, right? Because that's the ask price. But given that wide market, now that we're, now armed with more analytics, we could see that, well, wait a minute, that 85 cents, is very high. So let's just come back here. I'm going to come back to the volume analysis. Let's just see where it's trading. You could see that the average VWAP price is 52 cents, where the market was 36.64. So it is trading in between that market, right? Bid and ask. So there's potential for improvement. Okay, so there's potential for price improvement. So if we were interested in it, we could see that, yeah, 85 cents is the offer, but there's a lot of trading going on and willingness for market participants to trade in between. Okay, so that's important, and we have this information now. And when you're trading, all these factors come into play. All right. But the idea here is that we could quickly now go through, some of these trading activities, and just using the IV, we could see, well, where is it currently offered relative to the historical average benchmarks, right? This is how far above or below. And the percentile rank is telling us how many of the historical observations that we captured are below this current market. So if we're looking for something maybe that are trading markets very low, like for example, here's one in TLT. This is saying that 2% of the historical observations were below, where the market is right now. Most of that means 98% were above, right? So if we open that up, you could see that, 51 cents, most of the time, and they're close, right? So these are, TLT is pretty tight market, but it's on the lower end of the historical range. So what this allows us to do is compare more apples to apples instead of just looking at the implied volatility of a 30-day IV, which doesn't really tell you where the options are priced. It's giving you like a general feel for the level of implied volatility if we used 30-day constant maturity at the monies. But when we're looking at options, maybe with earnings or with 5 days to go or 10 days to go, or 20, we got to evaluate them separately based on those factors. And that's what this is helping us do really quickly right from the options chain. Okay, so well, I'm going to stop right there and throw it back to you.
Great job, D, as always. Thanks for bringing these webinars to the Chameleon community. You have a great day, and we'll see you tomorrow, my friend.
All right. Thanks, everyone, for joining. Stay safe out there, and have a great trading day. We hope to see you tomorrow.
Have a great day, D. Bye. Hey, everyone. Thanks for joining another Market Chameleon webinar. If you're following us on any social platforms, please thumbs up. Any comments, please give them. If you're not following us, please follow us. If you're on YouTube in particular, please thumbs up. Everyone have a great day, and we will see you tomorrow. Bye.